I'd like you briefly, very briefly, we're not going to go into bios, all your bios are there, but what are you doing at the moment as it relates to impact investing? And I want to really go into this issue of, if you speak to the wealth managers, they will complain, no, it's the client. The client's not interested. And if you speak to the clients, no, the wealth managers don't want to do this. So somebody's not telling the truth. So Tasha, just tell the audience specifically what you're doing within your organization.
Sure. So we at Impact Engine are one of the accelerators that Irene talked about. And what we've seen, we launched in 2012. And what we've seen is a great sort of rising tide of the number of people who are attending our events, want to talk to the entrepreneurs that we're working with, and who are very interested in impact investing but don't really know how to get started. And so we try to provide an entry point for them to sort of write small checks, have big impact on young companies, and that for many of the folks that are involved at Impact Engine is their entree into getting started, and it's the beginning of an exploration. And we share with them openly some of the challenges of working with advisors who don't have familiarity, because track records are very new in this space, and there's not sort of long histories and teams that have done this for a long time. So a lot of the traditional processes around vetting managers aren't there yet, but we view ourselves as being able to provide sort of a map for folks in terms of who's doing what, who's pushing the edge, who's doing interesting work across asset classes. We also are seeing real rising interest from the advisors and from the family offices who are getting more and more questions from their clients. And more interest, particularly as the millennial generation starts to be pushing on the gas. And so I think it's a chicken and egg problem. I think part of it is managers and advisors getting familiar with what it means to make impact investments, and clients who are really relying on these folks to be their experts and advise them, pushing. So you're starting to see, I think, a lot more movement around this. Certainly a big change since we started 2 years ago.
Pessimistic, optimistic, or disgusted?
Optimistic. My background is as a venture investor. You have to be optimistic to invest in entrepreneurs. And I've been around long enough to see some cycles. And sometimes you have companies do amazing things and change the world in fundamental ways. And sometimes it doesn't work out. But I really see the conversation is so much more sophisticated than it was 2 years ago, so I'm optimistic.
Okay. Debra.
So first of all, I'm excited because we've been doing this since 1986. We have never had partners like this before. We've never been able to have these kinds of conversations. And so truly, I think, just what Irene said, there's the shift with millennials, there's the pressure that's happening in the marketplace, and so there is a drive for product, right? And we hear in all the reports, we need product, we need product, we need product, we need something. If people want to invest, we got to give them stuff that's investable. So that creates an incredible new opportunity for an institution like MacArthur. I will be clear, we are unabashedly philanthropic in our orientation. The reason we are in impact investing is not actually to make the lives of regular investors easier. It's not actually to make wealth managers wealthier. Our purpose is to solve really tough social problems that the IRS and foundations consider philanthropic. Poverty, education, health, housing. And so, in fact, for us, impact investing is all about trying to harness this connection, right? The connection between mainstream capital and are we being taped, tweeted? What's the rules here? The really flexible, it's not just patient, it's flexible money. And I can say a little more about that later, but it's the money that makes it possible to connect what investors need and want on the one side and what will really work for enterprises on the other side, whether they're nonprofit, whether they're for-profit, whether they're hybrid, joint venture, whether they need equity, debt. Doesn't matter sector, geography, there is really often a mismatch. And it's not that you can't make mission-aligned investments, but if you want to get at the hardest problems, listen to Irene's story, because no one would take the currency risk. We see all the time situations where it's not anybody's fault. Something is just too novel. Somebody has to willing to be the seed capital. Something is just growing, and it's just too risky. Somebody has to backstop that. So we see our role as providing the credit enhancement, the liquidity. You know, what are the market-making mechanisms that allow us either to structure standalone products and vehicles that open up opportunity for the larger investors to play more easily, take the friction out of the system. And we see increasingly a challenge around liquidity, because we think if you want to give patient capital to enterprises, especially the kinds that Impact Engine's working with, or the small schools that Irene's working with, investors don't want to be in for 20 years. So how do we figure out that mismatch? And I think for MacArthur, as a player with $300 million dedicated to this work and a 30-year experience and lots of models to draw from, we're increasingly seeing that issue of building not just play-by-play models, that's important, but true market clearing mechanisms, syndication, securitization, liquidity facilities, we see that is where we need to push our innovation frontier to take advantage of all this new opportunity.
But the $300 million is a portion of the endowment that's been allocated for impact. I heard 80% that of the assets are mission aligned. How much of MacArthur?
So let me say that if you meet one foundation and you ask them about how they think about their impact investing work, you've met one foundation, okay? Some foundations think about it as a carve-out of their endowment. Some of them say, I have some of it carved out of my endowment, and I have this other thing over here called program-related investments. Most foundations, private foundations, especially large established ones, only today have program-related investments. And it can be large. Ours is $300 million and has been for over a decade, and that's 5% of the assets on the foundation's balance sheet. Gates has $1 billion allocated to program-related investments. Ford has, I think, about $400 million. So these are significant dollars. Program-related investments are what are called assets held for charitable purposes. So the endowment are assets held for investment purposes. So this is a fine-grained distinction, right? Because it's all part of the foundation's balance sheet. If we make a program-related investment, it is still an asset. It's a receivable. It's a loan. It's an equity investment. But we're making it because we're trying to advance our philanthropic purpose, if you see what I mean. It is,
I see what you mean.
And we put all of that in one pool.
We're still working with the 5%, not the 100%.
No, the 5% is not a balance sheet item. And we have a room of investors and MBAs, right? How many of you don't know the difference between an income statement and a balance sheet? Fess up. Professors, do your job. The 5% that you're referring to is not a balance sheet requirement for foundations. That is what's called the annual distribution, charitable distribution requirement, that every year 5% of the income, right, of the assets has to be paid out. If you're not doing that, if you're not paying out 5%, you're not meeting this payout requirement, right? That's an annual expenditure that you have to make. When we make a program-related investment, it counts toward that, but it still sits on our balance sheet as an asset, is all I'm saying. So we actually have 5% of our assets, or a little more, sitting in program-related investments as an allocation. We combine mission-related investments and program-related investments in one pool that we call impact investments. Part of the reason for that is for a private foundation, this issue of what's a program-related investment and what's a mission-related investment is actually an incredibly gray area. And so the other thing I would say about us is we believe that great impact investments that give big, scaled, easy, market rate opportunities to investors to have deep social impact, we believe those are made, not found. They're not just lying around in the street. People are doing what Irene is doing. They're doing what I'm doing. They're doing what Impact Engines investors are doing. We believe that our kind of money is what helps make those things possible by taking risk, you know, by sitting in places that other investors won't sit. And so that's the money that we focus on. We're the but-for piece. That's our stock and trade. That's the sole focus that we have for our impact investing work, because it's plenty hard to do that well, and we're not trying to do anything beyond being as innovative and creative and productive as we can be with the enormous opportunity that we have.
But when, Irene, when you decided to move most or 80% of your endowment from the foundation to mission aligned, and you were speaking to your wealth manager, make it happen, and they weren't really too keen to make it happen. So did you dump them and find others that did, or did you educate them and now they're fans?
Yeah, we bullied them.
You bullied them.
Our wealth advisors, I had a very, very long-standing relationship with our wealth advisors, and we had...
all double-name companies?
Pardon?
All double-name companies. See, all these banks have double names.
Yeah. Anyway, so they'd also been doing very, very well for us. So I didn't want to have to go through all the RFP process, and I don't even know properly how to read them, and so it was sort of like, let's make our wealth advisors do this. And so we kind of pushed and shoved, and they came along a little bit grumpily at first, but they started to attend a lot of the different conferences. They started to research it, and they started to really understand that, first of all, they could see the trend. They could also see, hey, listen, it's not just Irene and her family that are going here. My God, there's more and more people jumping on this bandwagon. And I just think that we found... We were determined that we were not going to give up any of our returns on our investments. If we wanted to do something that charitable, we would do it through the foundation, a public program-related investment or something like that. And in 2013, net of all fees, our endowment in their foundation returned 13%. So, you know, we have no squawks here. You don't have to give up any financial return. It's a question of the wealth advisor's ability to find good managers, to vet them, to screen them, and that they have done very well for us.
I've spoken to a lot of a lot of big private banks, and all very eager. There's 3 that are working on a very big project of integrating sustainability in all their product offerings, so that's a big job. They have a lot of people. And they're all saying, well, it's really hard to find stuff. Yeah, you know, if you're looking on Bloomberg, you're not going to find much stuff. So getting them, I'm not saying that they have to grab the machete and go out in the jungle, go find stuff, but there's a laziness also.
I think that there is actually a lot more product available in this country than people think.
Absolutely.
I don't think it's packaged properly.
Okay.
I mean, municipal bonds are pretty much social impact bonds. They're not marketed. The bond managers are not describing them as such to wealth advisors who have clients that are looking for social impact bonds or social impact products. We have stuff here. They just need to relabel it.
Yeah, Debra.
Can I give you 2 examples? So we know somebody who's put together a muni bond product because of exactly what Irene has said for small muni issues that can't easily get capital. huge sustainability themes, stormwater and other kinds of things, and they've been going around and talking to the wealth advisors and saying this is an impact investment, but they're not somebody these guys are ever, I've worked with them for 20 years in the affordable housing space. You know, 10 years ago, we put together a fund with them, $200 million, where 7 foundations created the credit enhancement and 23 banks who knew the affordable housing space. We created a $200 million fund, very successful. So to us, this firm is familiar because we're in the deep end of the impact pool, right? But to the more commercial part of the impact pool, I love, Irene, the cute, charismatic commercial. For those folks, they don't know this firm. And so there's this disconnect, right? So there's product there. What I was saying a minute ago, let me give you another example. We have a portfolio of $50, $75 million of seasoned investments in what are called community development financial institutions. These have existed now for 30 years in the United States in some cases, and we have a long track record of almost 0 losses in that pool. It's a wonderful way to bring capital to things like low-income child care centers, low-income health clinics, arts facilities, affordable housing, small business job creation, a whole host of things. Consumer finance that's not predatory, that serves immigrant populations. But I can guarantee you that most of those wealth advisors would say, yeah, that sounds good for my impact clients. How do I invest in that? So one of the projects we're working on right now is how do we start creating product by taking the raw material that has existed inside our PRI, our program-related investment portfolio, now that we've de-risked it for the last 25 years. How can we package it? How can we create market, environments in which, through regulated brokers and so forth, that kind of product could start to be transformed and made available? Because that's what I mean. I think there is product, and some of it has deep impact, but we're missing this middle piece, and it's not fair to ask these impact advisors or funds or wealth managers, they can't do what I do. That doesn't make any sense. We're down at the retail, end putting these things together. So I think we need a lot in this missing middle, to take advantage of the opportunity.
So bullying, packaging, what else?
Well, that's Irene's job.
Okay, you have.
I'm into packaging.
You have. There's a very interesting Dutch foundation called Stichting 1818 Foundation, and it was a savings bank, and they had about 500 or 600 million euro in the foundation. And the CEO said, I want to start integrating everything into ESG and impact. So, and he said, I'm not going to do it well. I'm going to make mistakes, but I'm going to start. So he told his wealth manager, let's get started. Oh, we can't do that. That's going to be so hard. I said, okay, I'll go find somebody who will. And all of a sudden, the wealth manager was able to do that. And the CEO said, it's really not that hard to do if you want to do it, but it's really hard to do if you don't want to do it.
Yeah, that's great.
So what else? Bullying and packaging. What else?
I think this track record issue is an important one. I mean, track record of the managers that are out there and the instruments that are out there. I've grown up in the venture capital space, right? And there it's all about how long has this team been together? Have they been investing on the specific, investment thesis and strategy, and what does the track record look like? So you end up with, this challenge where without a track record, it's hard to raise the money, but without the money, it's hard to create a track record. And so, what we've seen is that there are really, it's high net worth individuals that really believe and are willing to take that risk and have a board of one, versus, a board of many, that are the ones that are putting that initial capital in. And so the track records are starting to build, but I think sort of, more time and more willingness to take that risk, and more folks that are willing to go up the learning curve and accept that it doesn't have to be perfect before you start doing something. That's what's going to sort of get that tide moving. But track record, I would add to your list of bullying and and packaging.
But I hear that also, and I hear it a lot from the two name banks that are around, saying, well, we really need kind of mainstream, core, scalable product.
Yes.
So I say, you mean like sovereign debt? Like which hasn't Spain, Greek, Italy, France, or subprime collateralized debt obligation. That was pretty mainstream core. And the stock market didn't perform in 10 years. So why is it that impact in ESG has to, like a basketball player, have to put 500-kilo weights on their legs while they're playing basketball, but it's okay for the others to screw up?
So I guess I want to sound a note of both caution, and I also want to suggest that we think really carefully about what we mean by impact, because there's a real spectrum here, and a lot of times it gets, you know, all kind of mashed together in a way that's important. You know, when Irene talks about going into Ghana and putting in the kind of sweat equity that she and her team put in to figure out proof of concept, right, to find partners on the ground, the microcredit lenders, to devise the programs, to, you know, to learn by doing, and to build this out, and then to take the risks with the PRIs that she could do because she had a private foundation and that no one else would do, right? We have to understand that's how you get to deep impact. And that's not going to ever be something that is going to be, you know, done with capital just flying off of a mainstream private wealth platform, right? Like, let's be honest, that's the R&D work of development finance, and it is also all about figuring out how to blend capital. How you get smart about when do you use a program-related investment, when do you use a grant, when can you pull in from a government partner, a DFI, an OPIC, or a USAID? When do you pull in money from a commercial bank? We work all the time in the U.S. with large commercial banks because they have Community Reinvestment Act obligations. So we're all about the blending of capital and figuring out how do we play just the right piece to kind of make the whole thing come together. That's how you get to deep impact. When we start talking about the large-scaled investments, this is where the commercialization makes me concerned, because it is going to be very easy to say this is an impact investment, and there's a lot of pull to say that because clients want product. And so there's going to be a sort of tendency, I think, to offer things that are nice to do, right? And they're going to meet investor demand, and they're going to be profitable. But we have to be careful not to pretend, you know, that they're going to solve poverty, right? Or that they're going to feed families that are starving in countries where, you know, there are challenges that rightly make it very hard for investors to earn a profit. Transaction costs can be structural barriers to earning market rate returns. Transactions can just be small. The duration of the investments can make it a barrier to a full market rate investment. We have to often do transactions with no collateral, so the risk-return profile is not normal and may never be normal. If I finance a building that houses women who work their whole lives and live on Social Security, and they have $9,000 a year of income, that building does not have enough revenue from the rent they can pay to cover capital and operating costs. That's just a math problem. So no one's going to get rich, you know, providing that housing. It doesn't mean you can't get paid back, but you're not going to actually maximize your financial returns. So there's a spectrum of impact and a spectrum of returns. It's not that there aren't at one end of the spectrum ways to get both, but if you want deeply, deeply focused impact and maximize financial returns, that's going to be very challenging. And I worry, you mentioned subprime, I worry about bad actors that will come in, just as they did in subprime, the subprime era, and say that something like a loan that is a bond, let's say, for a payday lender, because the money goes to a low-mod income, you know, minority community, is an impact investment. And people will snap it up because it's got a nice coupon on it, and because it's in a minority community, and it's actually the opposite of an impact investment. That's, to me, where, like, for philanthropy, you know, we have to be worried.
So for asset owners, okay, you probably have a network of asset owners. So what do you find the most effective trigger to convince them to maybe not go as quickly and radically as you went, or maybe even do more? What is the convincing argument for them? When
Are you asking me?
When you speak to them, I'm sure you've had lots of conversations with other asset owners, and they're asking, well, how did you do this and why did you do that? Do you find something, a common denominator, that is the trigger for them to start?
No. I actually don't have a whole lot of conversations with other asset owners about this sort of thing. I mean, the area where you have these kinds of conversations that are all the conferences that are impact investing conferences where everybody agrees with everything that everybody else is saying, you know. So I'm not actually too sure. I mean, I guess if we got a random group of rich people in the room, I could find out.
Well, I can speak to that a bit because we observe it in our community at Impact Engine, because I think your question was about triggers, like what gets people started down this path of thinking about impact investing. And there are definitely some patterns to it. You know, for some, it's the birth of a child and starting to think about what kind of world am I leaving for them, and what can I do to change the picture that I currently see us headed in. For some, it's they have a liquidity event, and so they've been working really hard building their own business. They sell it, and suddenly, you know, they come into wealth and liquidity, and you know, they start to think, I think, really deeply about, you know, what that means, what kind of, you know, personal mark that they want to make on the world. You know, for others, it's they travel. That was my story. I traveled to, you know, one of these community schools in Zambia, not Ghana, but you know, that was where I first was exposed to this idea that you could take, you know, venture investment kind of approach to working with entrepreneurial organizations that were, you know, doing really important work serving next generation of children in these countries. So there are definitely, I think, some patterns. You know, millennials is another one. You know, where individuals start to ask the question, you know, we at Impact Engine believe that every dollar is an impact dollar, and so most people just don't understand what that impact is of their dollars that are at work, but the first step is starting to ask those questions, and those are the trigger events that we see.
I'll just say that with private foundations, because we have a network called the Mission Investors Exchange that started with the lovely title of PRI Makers Network about 12 years ago, and there were about 20 of us that got around a table and realized we were all making PRIs, and today there are 300. And it's community foundations and private and corporate foundations and family foundations are the fastest growing cohort in that network. And we get a lot of phone calls because we've been doing this a long time. And I think for a lot, it's really not about, again, impact investing. It's not about changing necessarily the practices of private wealth management. That's not really where they're coming from. It is about a set of program objectives they're trying to pursue, let's say education or job creation, and they want all the tools that they can have at their disposal because these are hard problems. So they want grants, but why not have program-related investments, and why not have mission-related investments, and why not, given how hard these things are to work on, you know, give yourself every possible way to, you know, to make impact happen. And that, I know, is for so many of the foundations, including our own, that's really been the driving motivation.
Irene, you said before that there were regulatory issues for product to be able to be sold here that were, are there lots of really interesting impact products that are not based in the U.S. that are not able to sell in the United States?
Well, yeah, they're not registered, and a lot of the, I think part of the reason that they're not registered is because the big banks, the people that would sell the product, don't think the product's going to be of interest to their investors, and this is where they are actually very misguided, and they better get religion real quick, otherwise they're going to start losing a lot of market share. But the other thing is that because we have such difficult regulations in this country, an awful lot of the global funds, the managers of those funds don't want to have anything to do with U.S. investors.
Really? So
there's a lot of things out there that are not open to U.S. investors.
Are U.S. investors allowed to invest in foreign products as long as they're not marketing in the U.S.?
Ones that are registered here.
Oh, okay. No, if they're not registered here, but they're in, I don't know, in Switzerland.
No. No, you can't. You can't go, because, like, for instance, Credit Suisse has several super funds, but they won't accept any US investors into those funds. And actually, I had a conversation with the corporate heads in New York of Credit Suisse, who, on this exact topic, which resulted in them going over to Zurich to have a chat about how maybe they could get some of those products actually made available to some of the US investors.
Having we've done a lot of, presentations and management briefings, and I always say jokingly, we focus much more on irresponsible investors and criminals. Mainly, they have more money, and they're very predictable and they have a better sense of humor. It's not that I never really found it that difficult on the convincing side. Access was the hard part. Convincing, I didn't really find that that difficult, and also with even on the wealth management side. I mean, fundamentally, most people want to have some type of fulfillment in their daily lives. So, if that's all true, why is it taking so long?
I don't think it's taking as long as we think it is. I think, as I said, I think the things are turning upside down very, very rapidly. There's more and more and more being written about the role of impact investing, what it is, trying to define it, trying to establish metrics for impact. What are we measuring? Are we measuring, how do you combine financial returns with the level of social impact? Is social impact, positive social impact in one country at the expense of a social impact in the delivering country? There's such confusion around trying to establish a reliable set of metrics to start measuring this. But I think that I believe very much that now pretty much every, the wealth advisors and wealth managers that are not having impact investing very well embedded in their brains at the moment are really truly out of touch. I think this thing is moving very, very fast.
But you still bump into dinosaurs.
Well, none that I talk to.
I agree with Irene. I mean, I've been managing the impact investments for MacArthur now since 2001. I came from a traditional investment banking world. I certainly had never heard of program-related investment when I came to the MacArthur Foundation, and was very skeptical when I first learned about the tools. What can you do with a $1 million unsecured 2% loan? How could that possibly mean anything? Because I did $30, $50, $200 million bond issues. And it was fascinating to learn about this whole field, right, of community development intermediaries, microcredit intermediaries. Before there was the term social enterprises, but organizations, nonprofit, for-profit, that were delivering really powerful social impacts, but running in a business-like way, generating their own steam with an ability to use credit and equity and return, maybe not maximal, but steady or meaningful financial returns. So, when I think about how the first 15 years, 20 years of MacArthur's experience was just learning how to do that, one-to-one, working one-to-one with these enterprises and seeding them all over the country. And then over the last 15 years, we've had the opportunity to do all kinds of structured funds, raise $200, $300 million of capital, putting in a $20 million guarantee. Because once we do that piece, Mass Mutual comes to the table, 5 banks come to the table. So we've seen the unlocking power start to multiply and had more and more opportunities to create product. What we never had in the last 15 years was the kind of phone calls I get now from wealth managers. And that's because people like Irene and others and some people in her family that we know, people are saying we want these products. And so to me, this is very recent, and it's very fast, And it's for those of us that have had the long experience of using the philanthropic dollars in these creative ways. I think that's for us to then figure out how we partner in this new generation of innovation. But I don't think it's slow.
Well, and I would agree with that. I mean, we started Impact Engine 3 years ago in 2012, and at the time, you know, we really felt like we had to go out there and convince people. Like we're going to go find the opportunities and make them investable. These companies that can be attractive financial investments, but also have impact baked into the product or service. And so we were very much out there trying to sort of provide the examples, the concrete examples in the early stage startup space. To show people that it was possible. And what we found is that the number of people who are coming, the number of calls from advisors and managers has gone up. We've also realized that there are people who are finding us who care about this. And we've been very focused at our first 3 years on working with the companies. And now we realize that there's a huge opportunity to work with the investors and create that network, because we're finding that the individuals like Irene and you know, Greg Lernahan, who's on our board, who found us, and others really crave the opportunity to connect with the people who are like-minded, investors who are thinking in a similar way that they are, to learn from them, to collaborate, to syndicate, to share knowledge. And so I think as you start to see more and more of the pioneers out there that are getting out in front of groups like this, I think you'll start to see you know, an effect where things start to move more quickly and exponentially, you know, because we're connecting the dots between, you know, some of these, you know, folks who have been on the early edge of thinking about how to invest for impact.
You have to remember that this really is a marketplace. This is not, you know, going to be tidy. It's very organic. The investors' objectives and motivations are really diverse. So what Irene is looking for with her program-related investments is different than what she's looking for perhaps in the investment portfolio. What we're looking to do with our sort of, you know, kind of product innovation, you know, platform creation, that's different than a Kresge Foundation, which is super focused on innovation around the health sector, which is going to be different than an individual entrepreneur who's got some wealth and wants to be hands-on working with young, you know, thriving social enterprises. So some people are maximizing, you know, the portfolio return for a large, you know, institutional kind of entity. Others have, you know, get to have a meeting of one, which is, you know, a whole other kind of opportunity. So this is a big mad mix right now, and I think we have to be patient as things kind of sort through and the innovation happens. But I can tell you, because we're starting to make grants right now to help some of the new platforms to take shape, some of the new kinds of product concepts and packaging concepts take shape, we at least feel like we can help accelerate some of this, you know, connectivity, and we hope other foundations will start to see that as a role. I think it's tough because, again, we tend to be, as foundations, very organized into, I'm into housing or I'm into education, and focus is a good thing. But what you're really asking is, how do we build a marketplace that works for everyone? And I think we're just at the beginning of doing that in a big, serious way.
Some of the private banks told me that they were quite reluctant because of compliance issues of showing impact product that might not have been around for a while or might not have been performing, that they were really struggling with, you know, we have a specific duty, you know, to screen it. So there was a reluctance on quite a few on showing them that. Some of them were fixing that by having the client signed a waiver that it's not my fault if you lose all your money. Do you find that an issue, or you said that people will get over that? That's not going to be much of a hindrance.
You're asking me?
Yeah.
Well, there are a lot of, I mean, you know, the big banks, the big investment houses, of course, have a lot of analysts. And then there's a whole committee that decides what is going to be on the platform that is going to be followed. So that's where the roadblocks have been. That's why when I was saying that our wealth advisors were willing to go off the platform and perform their own due diligence, but they never asked me to sign any waivers. I think they had enough confidence in their ability to take a good look at these managers and to give us their best advice. And if they would have asked us to sign waivers, we wouldn't have stayed with them. But I think that there are enough pure impact managers coming along the pipeline that have been the smaller boutique firms that are slowly building up their assets under management, that are doing due diligence 100% on these pure impact products. And so I think as more of those managers get on the radar of the big banks and they become part of their platform, and I think that is happening. I think that there'll be, understandably, the boards, the investment committees of these big banks are going to say, look, we're going to lose our market if we don't bring these kinds of managers onto our platform and we don't follow them.
Yeah, there are a few that are actually moving that, but they're glacially slow.
I think one of the other barriers, though, is scale. So when we have conversations with folks about this issue of what can you get on platform, the problem is that the volume of paper that they need is beyond what, like, for example, if you take affordable rental housing in the United States, which serves 30 million households and is an incredibly important thing for people who are, living on, full-time minimum wage jobs or living on fixed income or what have you. So it's a great impact to pay attention to, but as big as that marketplace is, the products that could be packaged up and put on the platform are probably still not big enough to actually feed the economics of that type of model. And so either you've got to have managers going off platform, or we got to figure out what else can we pool it with. And the problem there is you start to create a diversity of impacts. So we could probably create big enough product if we had housing and economic development and healthcare and education and childcare, for the U.S. and we put it all into one big fabulous-looking security, right? That some investment bank decides to structure, and so they have all the requisite, licensing and securities compliance. So it could probably be created. The problem is now you've got impact investors say, but I only care about education.
Okay.
So this is the tension. That if you want scale, efficiency, market rate returns, manageable risk return profiles, we can create that. We know how to make that, and program-related investments and the existing portfolios that sit on foundation balance sheets as PRIs could be used as raw material. But then we got to get over wanting also to have, super precise impact. So I think that's a big tension. It's a tension internationally as well.
It is, but on the other hand, I think that, when I'm looking at what types of companies, first, when you first start getting into looking at a whole portfolio, you go the normal route. You're going to negative screen, then you're going to positive screen, then you're going to start looking for managers that are pure impact managers. You're looking for fund managers that are running impact funds. But, really, some of them are specialized, but in terms of what we think about in our portfolio is I don't care whether it's agriculture or whether it's health or whether it's education or affordable housing.
That's great.
I just care about whether or not the lineup of companies and products, I don't care whether it's domestic, whether it's global. What you have to say if you're going to care about having your portfolio invested impactfully is it invested impactfully? Is it making a financial return for you, the investor, to encourage you to keep doing it? And are we doing some social good? And what are we doing in the end to relieve poverty? Now, I think education is the key to relieving poverty and solving many of the world's problems. But I will definitely not confine my investments to education-related investments. I also care care about agricultural products, agricultural insurance, all these kinds of things that matter in the developing world and that matter also in this country.
And that is, though, what I want to say is I think that needs to be lifted up and appreciated for how incredibly important it is. That broadness in terms of saying, that breadth, I don't even think broadness is a word, the breadth in saying that when you say I want to have a mission-aligned portfolio with impact, you're not asking to only have it be, one zip code in Appalachia around one issue. You're saying, I'm open, and I think if you take that approach, right, we're going to have a lot more opportunity to find and create product that works. And what I see is sometimes that there isn't that kind of, broad thinking,
But sometimes I think that lack of broad thinking comes, when you were referring to dinosaurs earlier, I think a lot of that broad thinking comes from boards of dinosaurs. I think that
we got bullying dinosaurs.
Oh no, what did I do?
She does it in such a nice way. Feels good.
Nice.
You've got, we've got the younger guys coming along. They're all in their 30s and 40s, their mid-20s, and girls. Girls, don't forget us. And I think that their whole approach to impact is much, much broader. Because, for instance, when I belong to an organization called the International Education Funders Group. Okay, so we've got huge, big foundations that fund money. And so when at first I was extremely hopeful. I thought, oh, I'll go and talk to some of these people. Oh, well, we're only doing girls' boarding schools in East Tanzania. We're only doing, whatever, chain school models in South Africa. We're only doing this. And who makes these decisions? The decisions are made by people who've never stepped foot in any of these countries before. So how can you expect there to be real impact by these people that are dinosaurs? And yet what you tend to find out, boy, I tell you, I know an awful lot of people that are the ages of my kids, and man, they have lived all over the place. They've traveled, they've been, they've seen, they've taught, they've done all sorts of things, and their knowledge of the developing world is light years ahead of my generation.
Well, and I think there's an important distinction here between, whether you're using impact investing as a philanthropic tool to achieve some very specific aims versus using it as an investment lens to understand what are the impact that my investments are having and how do I move those in the direction that are consistent with what I care about broadly. And so, I think those are very distinct motivations. We see both in the investor community around Impact Engine. And our limited partners are trusting us to make judgments about companies that we think are attractive financially, but also are going to create impact along with them, but are agnostic about what kind of impact that is. Mm-hmm. So I think they would fall into that, even though they may really be investing because they want to build the community around this, they're looking through an investment lens. But some of the investors in specific companies are taking very much a philanthropic lens. I really care about education, and so I'm interested in investing in, Think Circa, because they're working directly in classrooms, helping students, achieve their Common Core objectives around literacy, and they have some data points to show that. So they're very much, I think, two very distinct places where interest in impact investing comes from. And I think, we see people who start on one end, starting to broaden how they're thinking about, and I think that's a good sign. But they definitely come from two very different places.
I think that's a good way to put it. I wouldn't draw too bright a line because I think there are institutions that sit in the middle or this is blurry. And I think the really great thing about this space or marketplace is that we actually need each other in interest and can play together in really interesting ways. So for example, foundations that may have a very discrete philanthropic lens, say, I'm only going to do health, may have extraordinary capacity because of program-related investments, which if anyone wants a side conversation after this, the big sure, we all know what that term means because it's often misunderstood to be solely kind of below market. It means something a little bit more flexible than that. They have ability to take, we can take risk that is really outsized. We can do debt, we can do equity, we can do guarantees, we can do deposits. You know, so we have extraordinary flexibility in terms of the tools we can bring to bear because we get to be problem first, tool second. That may not be true for an investor who's trying to manage a balanced, you know, set of asset classes, right? They may not have the ability, or if let's say it's a pension fund under ERISA, they may simply not have the ability to do some of the, you know, unsecured, you know, or deeply subordinated kinds of things that are very catalytic. So I think we need to recognize, like kind of embrace the difference and say, this is a big field. It gets confusing because some people are coming at it in just the way Tasha was saying. But we need each other, and it's through that collaboration that we're finding and creating new ways for this money to get where it needs to go. But it's not easy to make money go where it doesn't want to go, right? I mean, that's really the bottom line. If it's really hard to do, it's hard to do. And, you know, markets are, to some extent, you know, we have to really respect. I'm not saying they're perfectly efficient, but, you know, I got my MBA at Kellogg, but all my professors seem to have come from the University of Chicago. You know, I do not operate from a starting assumption that the reason the capital's not going to place X is because investors are stupid. I think they're smart. What investor thinks it's a profitable proposition to go out and do what Irene did for the last, she's worked really hard for the last 3 years, I know, and you know, I think we have to respect the fact that there's a role for pioneers, there's a role for people paving the way, and the idea is those who can do that then open the path for others to come behind them.
So what can this audience do to help you move the needle?
Me? Are you asking me again? Well, I just think that basically reading the literature and reading what is being, I mean, this is in every single business magazine. It's online. It's I mean, the conversation. I think reading the conversations that are being conducted about it and thinking about it, is the way that you can move the needle. I think that you have to be very forward-thinking, but I think that most people in this room probably are, or at least are a lot interested in learning more. I think looking as you go out to work in the business world, in the investment world, working for companies that have certain mandates in the way they invest money, the products they invest in. You know, to show you, who was that guy that was telling the interviewee how to upturn the interviewer?
Larry David.
Larry David. That kind of thing, you know. I think there's a lot that you can do, but mostly I think it's just understanding the changing dynamic in the world as people are becoming more and more concerned about the geopolitical situation, about even just when we look at terrorism. I mean, really, why has it got such a grip? It's got a grip because all of those people are so poor and uneducated. They don't really have a proper education. So they're being turned into radical terrorists because they're being fed by the leaders of those groups that are finding that money through thug-like, mafia-like operations with ISIS or so forth. And this is where they're getting their love. They don't have any education, most of these terrorists. So we have so many things in the world that could be solved, you know, overpopulation, health. It all starts with education. But I think that basically the way that you can move the needle is by educating yourselves about these kinds of sentiments.
Debra?
So I don't worry about there being enough interest in impact investing. I worry actually about the opposite. I worry that we have so much and people are so anxious to be impact investors right now in some way, shape, or form that they'll either turn to the kinds of investments I mentioned before, where people actually end up harmed because it gets branded as an impact. So I worry a little bit about the co-opting, commercialization of the title. So I hope people will be vigilant and ask themselves and demand, rigorous analysis of, is this really what I mean to do? Is this really aligned with my values, or is it something else? And the second thing is, be patient with yourself. So find not only a trusted partner so that the thing that you're doing delivers the kind of impact you'll be proud of and that will matter. There are some of us that have been doing this for a long time before it was called impact investing. And we are here to share. We've done a terrible job of capturing what we know how to do, but we really want to help. And I think that's our obligation as more and more folks are coming into this space. We don't want folks to have to reinvent the wheel. So if you are trying to do, for example, a loan with a microcredit organization and you just want to understand the basics of what your tool might look like, reach out, to my foundation, to Mission Investors Exchange. If you want to know the legal stuff, we have general counsel. Irene is right. That is a great job opportunity. I hadn't thought of it before. But there are 4 or 5 attorneys in the country. I know all of them. And I can point you to them. And we can make sure that you have all the tools at your disposal and you're not led into thinking incorrectly that you can or can't do something. We've done a lot of interesting stuff, and we want to share that. So I guess what we're saying is, let's not have people in the rush to become impact investors we are going to all make mistakes, and that's what the field is about, right? We learn by building and doing, and we are going to fail. But I worry about failures that are totally unavoidable, like spectacular failures. Like the subprime crisis is a good example. I had grantees writing in 2004, 5, 6, saying that the nature of those loans was not only exploitive, but was going to intrinsically blow up, and that the spillover because of the derivatives market that was attached to it was going to have devastating effects in terms of foreclosures. And they were publishing papers predicting 2 million foreclosures, and everyone ignored them. So there are people that you might not have in your orbit, but we might have them in ours, and let's make sure that we don't tarnish the whole field by having investments that really
I think that's a great
needlessly collapse.
Tasha.
So it's interesting because I think all of us who are sort of pioneers out there on the front edge find ourselves compelled to be field builders, and I think that's a really good thing. I worry about, in some ways, the opposite problem, what Debra's talking about. I worry about that too. I have a lot of things to worry about. But someone once said, and I think it was exactly right, there's a high talk-to-action ratio around impact investing, and so part of what we're trying to do is actually take some of that interest and convert it into action. And we're trying to convene the community of people who are interested so that they can support each other in taking action. Even if it's a small step, a commitment of time, reading the research, having a conversation with Debra, sharing what you have learned and what your perspective is. I think it's all about connecting the dots and contributing to and participating in the conversation and then taking action. So that's what you can do.
Thank you very, very much.
Thank you.
Thank you.
Very good. Thank you, Debra. Thank you very much. Thank you very, very much.